Hey everyone, welcome back to the channel. I'm sure you've heard by now, but in case you haven't, the era of 5% rates are ending. Now, I'm filming this on a Tuesday, but by the time this releases, it's pretty fair to guess that the Federal Reserve will have cut rates for the first time in 4 years. Instead of pontificating on what you should do or trying to make baseless predictions on where I think interest rates will be in 6 months, which, by the way, no one can do, I'll show you what I'm doing with my own money today, given this news. Now, although no one can really predict where interest rates will be, it's impossible to understate how important they are to our financial environment. Warren Buffett makes an analogy that they're like gravity. Not again! If I was sitting in my living room and gravity went to half of what it normally is, then that would certainly change how I interact with the world. I mean, Buffett, he's gone so far to say that it would be the one metric he would put in his crystal ball if he had the chance. Check this out.
If I could only pick one statistic to ask you about the future, I would not ask you about GDP growth. I would not ask you about who was going to be president. A million things. I would ask you what the interest rate is going to be over the next 20 years on average.
Although we can't predict where interest rates will be, I'm definitely reevaluating what I'm doing with my personal finances. I'm reacting to the interest rate change. If you're new here, hi, I'm David. I became a self-made millionaire before the age of 30, and I did it by investing intelligently and saving diligently. And I did it on a military officer's salary. Okay, so let me show you what I'm actually doing, and I've had this planned for months. It's very important that we don't do knee-jerk reactions. If you've been following this channel for a while, you know that I publicly invested $100,000, and this is because I want this channel to be not just what I'm saying, but also show you what I'm doing. That $100,000 is currently allocated 10% in Disney and 30% in Lululemon, and then 60% in short-term government bonds, as I kept looking for a new investment acquisition. But I had another pool of money. I had about $360,000 in a high-yield savings account. And that's because M1, the brokerage that I'm using, is offering a 5% APY high-yield savings account. Now, I don't get any referral programs, so I'm not necessarily recommending them, and you can find a similar high-yield savings account across multiple brokerages. And here's what my thought process was. With that $360,000 earning 5% per year, that's $18,000 a year just in interest rates. That's free money, and it's on a basically risk-free rate. But interest rates are changing. This 5% is going to start going down. There's no question. As the Fed lowers rates, M1 would be losing a lot of money if they kept this rate at 5%. And so starting today, I'm gonna start dollar cost averaging that $360,000 into the S&P 500, which from the start, this channel has always recommended as a good strategy, and I highly encourage you to do that before you start getting into stock picking. The reason why we recommend dollar cost averaging so much is it removes so much of the risk, but allows you to get most of the upside of the growing economy. And it allows you to also be patient and wait for that great company trading at a fair price that is squarely in your circle of competence, that you can really understand and has meaning to you. You can buy it, you can just reap the rewards. It's equally as dangerous to be in a forced sale as it is to be in a forced buy. You don't want to just be hunting for a stock because you have the money sitting in short-term government bonds. I'm setting up a recurring transfer. It's going to automatically take $1,000 per month on the first of every month and move it from my high yield savings account, which is earning 5% for now, but that amount will go down over time, and adding it to this investment fund. Okay, so why am I dollar cost averaging at a really slow rate of only $1,000 a month? There's really two conflicting reasons. The first is that the market's at all-time highs. I do not like buying at all-time highs. I know dollar cost averaging, you're not supposed to really care, and I'm not. $1,000 is still a lot of money to me. I'm dollar cost averaging, but still enjoying that 5% interest rate for now. And that leads perfectly into the second reason. Rates are not gonna go to zero overnight. Again, people are debating all over the internet that is there gonna be a 25 basis point drop in rates or a 50 basis point drop in rates. The consensus of most analysts and economists is that rates will be around 3.80 by the end of the year. But again, no one can predict it. But one thing I do know is it's not gonna go automatically to zero. So I can still continue to enjoy, 5%, maybe 4% for a while that dollar cost averaging goes. And then I'm gonna wait for a market pullback and really step up my dollar cost averaging, as well as find some target for my active fund. I'm still eagerly waiting to invest that thing. All right, we teased at the top that we would talk about why interest rates are important. So let's get into that. I want to double click on my reasoning to move into dollar cost averaging here, because it unlocks a lot of things that are under discussed among most individual investors, but are the secrets to wealth. Take a look at this clip from 2019 of Warren Buffett. Remember, this is in the era of zero interest rate policy. So we're in the opposite approach of this. This is when gravity was really light. We're currently in an environment where gravity is heavy. I'll play the clip in full and then we'll unpack it.
I mean, it surprised me when you said you didn't think the market was overvalued relative to historical ratios, right?
Well, you've got to crank in interest rates because everything in valuation gets back to interest rates. And if you take the U.S. Treasury bill now, which is, we'll call it 80 basis points, depends what maturity, that means the U.S. Treasury bill is selling at 125 times earnings. Now, if your alternative is to buy something at 125 times earnings, or a good business whose earnings will probably increase at 15 or 18 times earnings, you've got to measure it against the risk. It isn't really a risk-free instrument, but the standard rate. And in 1982, the rates got up 15% or thereabouts, and that makes a lot of difference. I mean, you've got a choice with money. What do you do with it? In Europe, if you put it in the bank, you will be charged for having it there. I mean, it's better to keep it under your mattress. So, you've got a choice every day is what you do, and I think equities are cheaper than fixed dollar investments.
First, he says everything in valuation goes back to interest rates. Why is that? In the game of investing, you're always trying to maximize your reward while minimizing your risk. Buffett defines risk as not knowing what you're doing. When you invest in a business, there will always be a portion of not knowing what you're doing, because it's impossible to know absolutely everything about what's happening in that business and in that industry. Now, the key to minimizing is by doing your research and making sure that it's a business that's within your circle of competence, which is what we're all about here at Flank. But what if I told you that there's an investment that is risk-free? Well, academics call it risk-free. It's not actually risk-free, as Buffett pointed to in that clip, but you can consider it risk-free. And so what investors generally treat as the risk-free rate is what the yield on U.S. Treasury bills currently sits at. So when Buffett says U.S. Treasury bills are at 80 basis points, he does some quick mental math. By the way, that calculation that he's doing is called earnings yield, and it's basically just doing 1 over the number to get how many times of earnings it is. So he says 1 over 80 basis points. 1 basis point is equal to 1 of 1%. The number is 0.08, 0.0008. So 1 over 0.008 is equal to 125 times earnings. What this means is that at 125 times earnings, ignoring the effects of compound interest, it would take me 125 years to double my money or to get my money back. So remember, that clip was from 2019 when rates were historically low. Now that risk-free rate is around 5.33%, which is almost 6 times higher than it was in 2019. And if we use that same mental math that Buffett used, then we're looking at the earnings rate being 18 times earnings. So with interest rates around 5.3% like they are now, we switch that to being 18 times earnings. So it would take 18 years for the federal government to pay me back on my investment, or double my money. Again, this is ignoring compound interest, which is a huge thing to ignore, but it makes the discussion way more simple. The Wall Street Journal provided this really wonderful graph that shows where interest rates are today compared to kind of the main drivers of it. So inflation, we saw, did spike up, and interest rates over the course of 2 years were ratcheted up to fight inflation. But just like the last time we had interest rates climb up, and this was during a recession, you can see that even during a recession, we didn't cut rates overnight. That happened in 2020, but interest rates were already pretty low. I think they're gonna step down. But again, no one knows, and I'll be sure to react as things change. Thanks again so much to our Patreons for supporting this channel. If you'd like to sign up, there's a link to it in our description. We're offering early access to our Flank investing platform, and in the next couple of weeks, we're gonna be releasing a full course that walks you through exactly how to do Buffett-style research, from understanding the company's business model all the way to doing your formal valuation. So I hope to see you over there. That's all for this video. I really do hope you got something out of it. We'll see you next time.